Stocks, which are also called equities, are securities that give shareholders an ownership interest in a public company. It's a real stake in the business, and if you own a majority of the shares of the business, you control how the business operates. The stock market refers to the collection of stocks that can be bought and sold by the general public on a variety of different exchanges. Where does stock come from? Public companies issue stocks so that they can fund their businesses. Investors who think the business will prosper in the future buy those stocks issues. The shareholders get any dividends plus any appreciation in the price of the shares. They can also watch their investment shrink or disappear entirely if the company runs out of money. For more enthusiastic content, subscribe to our channel now. Don't forget to hit that like button on each video. Your feedback and new suggestions are always welcome. Let's make our content even better together. Type of stock. There are two main types of stock: common shares and preferred shares. Common shares typically come with voting rights, allowing shareholders to participate in corporate decisions, whereas preferred shares usually lack voting rights. Preferred shareholders have priority in receiving dividends and assets during liquidation. Common stock can also be very much based on voting rights, with some companies having multiple classes of stock. In a dual class structure, Class A shares may have more votes per share than Class B shares. The setup allows company founders to maintain control over strategic decisions and innovation. How to start investing in stocks? Tips for beginners. Number 1. Buy the right investment. Successfully picking stocks requires more than just observing past performance. While it's easy to see which stocks have done well historically, predicting future performance is challenging. To succeed in investing in individual stocks, extensive analysis and management are necessary. Professionals scrutinize companies rigorously, making it difficult for individuals to consistently outperform the market. Analyzing a company involves assessing various factors such as earnings per share and price-earnings ratio, as well as evaluating management, competitive advantages, and financials like the balance sheet and income statement. Relying solely on past performance or personal preferences when buying stocks is ill-advised. Instead, investors must anticipate future developments, a daunting task even in favorable market conditions. Number 2. Avoid individual stocks if you're a beginner. Many people boast about successful stock picks, often overlooking poor performing investments they own. This can lead to unrealistic expectations and confusing luck with skill. Achieving consistent gains in individual stocks requires unique insights not already reflected in market prices. Considering that for every seller there is a buyer with opposing beliefs, outperforming the market as a novice is challenging. An alternative to individual stocks is investing in index funds, which hold diversified portfolios of dozens or even hundreds of stocks. Unlike stocks, index funds may have annual fees, though some funds are fee-free. Number 3. Create a diversified portfolio. Index funds offer the advantage of immediate diversification by providing exposure to a range of stocks within the fund. Whether broadly diversified, such as the S&P 500, or narrowly focused on specific industries, these funds spread investment across multiple companies and sectors, reducing overall risk. Investing in individual stocks carries higher risk as it puts all assets in one basket. The simplest way to achieve diversification is through ETFs or mutual funds, which inherently offer diversification without requiring individual stock analysis. While not as thrilling, this approach is a prudent starting point and helps avoid the misconception of outsmarting the market. Diversification also extends beyond stocks to include investments across various industries. Number 4. Be prepared for a downturn. Investors often struggle with handling losses in their investments, especially since the stock market can be unpredictable. It's crucial to brace yourself for those losses to avoid making impulsive decisions driven by panic. Diversifying your portfolio helps mitigate the impact of individual stock losses on your overall returns. However, even index funds are subject to fluctuations, so eliminating all risks is impossible. Market downturns, like the one experienced in 2020, can occur unexpectedly, underscoring the need to withstand short-term volatility for long-term gains. Investing carries inherent risks, with stocks lacking principal guarantees. If seeking guaranteed returns, alternatives like high-yield CDs may be preferable. Understanding market volatility is challenging for both new and experienced investors. It's essential to recognize that volatility exists not only when the market declines, but also when it rises. Number 5. Try a stock market simulator before investing in real money. One way to ease into investing without risking real money is by using a stock simulator. These online trading accounts are virtual dollars, allowing you to practice without financial consequences. It's a valuable tool for understanding your reactions to gains or losses. We suggest this approach to dispel the belief of outperforming the market. Reflecting on your investment goals can help determine if stocks are the right fit. If aiming to beat the market, trying a simulator first is wise. However, for long-term investing, we advise diversifying with mutual funds or exchange-traded funds. Bankrate has reviewed some top investing apps, including enjoyable stock simulators. Number 6. Stay committed to your long-term portfolio. We stress that investing is a long-term commitment and suggest investors distance themselves from daily financial news. Avoiding constant monitoring of news helps develop patience, crucial for consistent investing success. Infrequent portfolio checks also help curb emotional responses to market changes. These tips are especially useful for novice investors grappling with emotional management. Establishing a set schedule for a portfolio review prevents impulsive decisions during market fluctuations and maximizes returns as recommended. Number 7. Start now. Investing in the stock market isn't just about timing the perfect moment, it's a long-term commitment. Starting sooner rather than later is essential for capitalizing on the power of compounding. Taking action now and maintaining a consistent savings plan over time is crucial for achieving financial goals. Number 8. Avoid short-term trading. Understanding your investment time frame is crucial for determining your strategy and whether investing is suitable for you. Short-term investors often have unrealistic expectations and face stiff competition from high-powered investors and sophisticated algorithms, resulting in frequent losses. Moreover, frequent buying and selling of stocks can incur substantial fees and taxes, eroding potential returns. For short-term goals, it's advisable to consider alternatives like savings accounts, money market accounts, or short-term CDs, as investing in the stock market may not be suitable. Experts typically recommend investing in stocks only if you can commit your money for at least 3 to 5 years. Funds needed in the near term should be allocated to low-risk options to ensure availability when required. Number 9. Keep investing over time. Building real wealth takes time and discipline. Rather than simply dumping money into the market, successful investors consistently add to their investments over time. This requires a strong saving discipline where a portion of each paycheck is set aside to be invested. Automatic transfers, such as those found in 401,000 retirement accounts or brokerage accounts, can facilitate this process. By automating investments, emotions are kept out of the equation, allowing investors to steadily grow their wealth and achieve their financial goals. Thanks a bunch for sticking around until the end. You're a legend. Don't forget to subscribe and like our channel.